Hey everybody, Marty Missouri here. It's the 17th of May, 2025 with your weekend update on markets and on the economy. As for the economy, our PWA index did not move today. It's still a negative 9.30 after improving by 7 points last week. In my midweek snapshot on Wednesday, I talked about several things, the last one being the impact of tariffs, potential impact on the economy, even at just the 10% across the board level. So I thought for today, though, I had several things lined up, but I just read this article by Ed Harrison with Bloomberg, and I thought this probably would just be a good subject matter for us to discuss today before I get to the charts. And the title in Ed's article is, "If Trump wants low rates, he'll need a recession now." Macro view. So now, recall, as I keep saying, while recession still remains our base case, although less so now that the administration has come way off the tariffs on China, I would argue that 30% is still recessionary, but 10% may not be. But nevertheless, like I just mentioned, our PWA index is in the red, and the way we read that is that recession risk remains higher than continued expansion risk on a go-forward basis. And it doesn't predict any timing. It just says that the risk right here is high. But what I'm saying is if we don't have that slowdown, then we don't have interest rates come down. And I'll show you an interest rate chart here in a second. And therefore, we have pressure. Valuations where they are in U.S. equities, higher interest rates exacerbate that, frankly, in terms of the attractiveness of stocks, particularly at these valuations. I showed you a couple videos ago that bull markets historically just never start from these high valuations, nor do bear markets tend to end. And that's a big debate right now. Are we in a bear market? Did we have another swift one like 2020 and it's already over? Could be. And as I said the other day, the technicals are beginning to look pretty favorable to me. Big difference between now and 2020 is in 2020 you had previously unfathomable stimulus come into the market. Unequivocally, we're not getting that right now. And the problem is, and this is what Ed kind of alludes to here, is that if we try to stimulate, interest rates aren't going lower. I would argue that they're going higher, particularly if they ease off dramatically, as it looks like they're going to, on the tariffs going forward, on the trade wars, and that they do all these great deals that actually, well, counterintuitively, you'd say, well, that's good because there's going to be lower tariffs, therefore there's going to be lower inflation. Yeah, all things equal, sure. Meaning if the economy could survive higher tariffs, well, then you'd have higher inflation. But I think you could argue that tariffs are disinflationary or deflationary, particularly if they are high tariffs, because the impact on the economy would slow things down. And ultimately, tariffs notwithstanding, across the economy in the aggregate, you'd actually see a slowing and you'd see some disinflation. But it's the disinflation or deflation that comes with a recession when everybody is just feeling really poorly about their economic situation personally. As he says here, while the Trump administration's policymaking has been ever shifting, markets have reached consensus on one thing. The president's report card is now the performance of long-term yields rather than stocks like they were in Trump 1. Long-term yields have become structurally higher due to fears of higher deficits and inflation, as well as the hopes for growth. That combination will raise yields to a breaking point where Trump will either fully capitulate on tax cuts and tariffs, or high yields will help tip the U.S. into recession. Scott Bessent said back in February that that's their focus, on bringing down the 10-year yield. And I think he was probably celebrating that they had declined nearly 40 basis points from the year's high. And Bessent's telling this was the bond market's recognition that Trump's policy goals of tax cuts and deregulation augured for non-inflationary growth. I unequivocally disagree with that, folks. I think what this suggests is that bond yields were declining out of fear that we were going to see a recession in 2024. Here he says that things look quite different now, with markets more worried about the opposite outcome, inflationary stagnation, that fear over recession is actually what brought yields down. Large tariff increases have overtaken them as a drive of yields. And I don't know that I would agree with that, quite frankly, but that's what's driving yields right here. I believe it's actually the fact that they have lowered the tariffs and therefore combine that with some fiscal stimulus that they're going to try to pass with this big bill actually would be a driver of inflation. And so I would say that the receding fear of recession, not the worry of large tariff increases, is what has yields driving, meaning if there's not going to be a recession, then therefore there's going to be expansion and growth. And this economy doesn't really have the capacity to absorb much of that without higher interest rates and higher inflation. And as we've discussed, illustrated, and notably benefited from this year, there was for a while there quite the exodus away from U.S. equities, for example, into other equities, Eurozone in particular. And as that went on, we saw a decline in the dollar and a rise in the euro to kind of validate that what we're seeing there. We have, as I said on Wednesday, we have seen a really nice rally in the U.S. And I think at least in the near term, we've seen some of that money come back and try to capture a bottom in U.S. equities, as clearly that we're not going to have these incredibly strict and destructive tariff levels that were originally threatened. So the Federal Reserve can't help either, though recent retail sales do show kind of a flagging of consumer spending that in a pre-tariff world, I would say may see the Fed cutting from what officials call a moderately restrictive level. The central bank remains in a wait-and-see mode, principally because of uncertainties surrounding tariffs. I think it has to, and certainly because of that uncertainty, but also and definitely because of the prospects for the economy not to weaken, not to roll into a recession, but to actually come back some and start expanding if we get this big fiscal stimulus. And then throw in the 10% tariff, then you have a really ugly kind of a stagflationary environment. And definitely you're not going to be cutting interest rates. And that is problematic for stocks at these valuations. So in summary, the only macro variable moving long-term yields appreciably lower is fear of recession. And I agree with that because I'm in the camp that says that rates are higher because recession odds have gone down a bit here of late. So on the topic of rates, this mountain chart, the white line, is the current average 30-year mortgage rate at 6.89%. And here is the current 10-year Treasury yield. The mortgage rates will track the 10-year Treasury rate directionally. Of course, higher mortgage rates are a drag on the economy. Another thing I think worth noting is, and this is why I keep referring back to 2022, where the stock market buckled under the weight of higher interest rates. Notice, and that's the blue line here, is the S&P 500. You can see the negative correlation, but not 100% all the time, right? So here you had rates spiking in 2022, and here we had a 27% peak to trough decline in the S&P, and people were worried about the economy. People were fearing over inflation in 2022 while rates were rising. So that's that stagflation, stagnant economy and rising inflation scenario. So notice that right in here it was almost perfectly negatively correlated. As rates went up, stocks went down. The minute rates peaked and began to come down, stocks went up, and so on. So here we are in early 2023, yields coming down. The 2023 was the year where virtually all economists and analysts and investors, including yours truly, thought we were going to have a recession, and we didn't. And it wasn't all economists. There's one who I have a great deal of respect for, and I read all his stuff, who told us we were all wrong, and he turned out to be right. And by the way, the same gentleman actually sees recession in 2025, although he just lowered his odds from 75% to 60%. So we'll see if he's right once again. But notice that even though the market climbed as we came bouncing back in 2023, it got too high, and the stocks just ultimately had to buckle under the weight of those higher interest rates. And sure enough, the minute rates began to decline, stocks began to rally again. As rates bottomed, stocks continued with their momentum, but finally there came a point where they just couldn't take it anymore and they rolled over. until interest rates peaked. They rolled over. Stocks began to rally. Stocks did drop a little bit there in the summer of 2024 while rates were dropping. And then when rates bottomed and began to rise after the election, we had that, that wonderful mix of, with the new administration, we were going to get all this great stimulus like we did in 2017. And initially, the market viewed that as positive. And we were saying the whole time, be careful, because we have a much higher interest rate backdrop and inflation was non-existent. So those same policies were destined to push interest rates higher. And how high did they get to go before stocks began to fall? And this actually was the big, ginormous tariffs. And you see yields going down, not up. That's because it was widely believed that those high tariffs were ultimately going to bring on recession. And in a recession, you're going to see stocks fall with interest rates, no doubt about it. But now, the short-term deal with China, 13 hours after the Liberation Day tariffs were imposed across countries, were taken off or ratcheted down dramatically. And then what happened? You immediately had yields rising again. Now you have stocks also rising on that huge optimism, that the tariff situation isn't going to be completely destructive, coming off of this bottom. So yeah, a lot of FOMO, a lot of shorts were getting covered and so forth. But folks, make no mistake, if this yellow line continues to ascend, this blue line is going to descend, much like it did back in here. So my whole point is rates are going up because recession risk has gone down, but rates going up ultimately are going to be problematic for the stock market. So for us, we just need to continue to stay on our toes. We've had a really, really good year so far, particularly for the risk that we've taken or lack thereof. But it has to do with other things, other asset classes other than just stocks, and other stocks in the world other than just U.S. stocks. Okay, so just really quickly, the daily chart, which I told you last time, is looking a lot more constructive, no doubt. And we've just barreled through this 200-day moving average. Now, I will tell you, though, that something like 90% of all gaps end up getting filled, and that's quite the gap right there. So we should expect a pullback to this level right here. Doesn't mean it has to happen. A gap that won't get filled is the one that pops up and the market just keeps ascending off into the horizon. More often than not, gaps get filled and there'd be some support probably right there, just below the 200-day moving average. And again, that's an if, but I'm just telling you that that's very, very common. The momentum is beginning to slow down here just a titch, and that's what it's illustrated here by this histogram. And we are virtually in overbought territory. Some of the sectors like tech are extremely overbought, and tech is a big part of the index. So if we do get, let's say, some corrective action after this big week that we just had, this is the kind of RSI reading that tells you that should be expected. As you can see right here, we touched it and consolidated for a little bit and then saw probably, a high single-digit decline there. And then you had these bearish divergences that told us to look out below, and then we got a 20% decline. Back in here, we got notably overbought before we saw, I think an 8 or 9% hit to the market. So this is where you begin thinking about a rest when you get a big move like that and ultimately coming down. If we get our recession, folks, it's going to come down and it's going to blow right through this bottom. And if suddenly the inflation data begins to heat up because they're throwing a lot of stimulus in the market, we could see something negative as well there. So the market is kind of between a rock and a hard spot right here. NASDAQ 100 index, virtually the same look. Went barreling through the 200-day moving average. And again, this should have been pretty strong technical resistance, but it wasn't going to resist the news that we're not going to have 80% tariffs or 100% tariffs on China. Quite the gap here to get filled. That one would get filled virtually right on the 200-day moving average. I'll actually be surprised if we don't see that in the coming weeks, but maybe not. We'll see. Of course, I'll be here to report to you on it. The dollar blew through the trend line. It's still above it, resisted right at the 50-day moving average, and it's just kind of hanging out right here. I've been saying the dollar wants to go higher. Right now, I'd be neutral on the dollar short term. I am bearish on the dollar long term. I think it's coming down over the next several years. 10-year Treasury we're rising here. We did come off of that here on Thursday. That would be data driven. And then Friday, we came up a little bit off of that. Again, if the economy is going to start ripping again, rates are going higher. And then gold, really glad that we hedged it back up in here. If there was one chart that I had high conviction in, that it was telling us something that we should respect, it was this chart. We had really kind of a blow off top, a bearish engulfing candle, island reversal pattern, yada, yada. Did come back, test it one time, had a double top, and down about 11 or 12% since then, finding some support at the 50-day moving average. It'll be interesting to see if stocks do suffer next week and there's some fear gold may come back. Our concern is that gold could go lower before it finds a base. Therefore, we've hedged our position with options, so we're not taking that much of a hit in our gold position, which has been great to us this year. I think it's still up like 20% this year. And let's see, I showed you, we went over mortgage rates. So folks, let me just stop right there. Hope all that is useful for you. Hope you have a great rest of your weekend, and I'll be back next week. Take care. Bye-bye.